So we're going to go over 5 different sections today. This is from our perspective, my lending experience as a community-based lender who analyzes personal and business loans. This is not universal. Every bank does something a little bit different. Every lender kind of does a little bit different, but this will help build that framework that you need when you are applying to capital. Our goal for this training is to be as prepared as possible when you are applying for a small business loan. So the first section is going to be, what are the essential questions? So when you are applying for loan, the first thing you need to know is, what is your timeline? Have you started your business yet? Do you plan to start your business in the next 6, 12, 24, 3 years? Where are you at? What does it look like? So based upon your answer depends on what you already have. So have you started your business yet? Okay, great, you did. What does your cash flow currently look like? Do you have cash flow history, or are you starting with the projections? So that's kind of going to depend on where you're at in the business process. Do you plan to start a business? Are you kind of looking for startup working capital, things like that? If you're going to plan on that, when do you think that's going to happen? 12, 24 months, 3 to 5 years, like where are you at? There's no wrong answer to the question. It's basically,
Where are you?
Where are you at? But you have to know where you're at in your timeline to figure out what lending route you need to go to. Where are you going to go to get your money? Question 2. Once you have your timeline, you want to know, like I said, it's going to dictate where you're going for your money. You can go for a term loan or a line of credit. Line of credit is revolving. A term loan is one flat out amount, and you automatically start paying that back. Corporate banks, community banks, credit unions, most of the term loans and lines of credit, you will go to the banks for that, or the credit unions. They are, they do SBA guaranteed loans for existing businesses, and then they typically do traditional loans as well. Your second option is going to be CDIS, which is us. So that's a mission-driven lender. Or you could also go to your local community, town, county business funds, and they may have a revolving loan fund that they're able to help with the grants. And then, of course, investors. If you have investors, there's a lot of angel investors out there that your cause, your purpose might fill their cup, and they are willing to invest into your dreams as well. Grants. Is there any grants that you are trying to take advantage of? Most grants have their own timeline, so you got to. Sometimes not. Everything's a little bit different when it comes to grants. It could be grants for women-owned businesses. I've seen that. I've seen grants for downtown projects. I've seen grants that your county will use to basically drive business. So maybe they'll do different types of grants that may fit into your demographic or your targeted area. They're not always a cash disbursement. They are often a reimbursement. So sometimes they'll say, okay, you use $500 and then you can apply for this grant, and maybe you'll get approved, and then they'll reimburse you the $500, if that makes sense. Sometimes they'll do like a match up to 50% of what you spend. You'll get 50% of that back. It all depends. Every grant is a little bit different and tailored to whoever is giving it. So I believe that the economic development has a list of grants for the area, and the SBDC does that as well. And so we can get in contact with them to get a list of those. They can also help you decide what box you fit in for them. The last option is self-funding. Most small businesses self-fund. Um, they go through their savings, they liquidate an account, they go to their family and friends for loans sometimes to get it started. Um, Often with small businesses, you often assemble a funding portfolio. So it's a mixture of a little bit of everything. Typically, you'll have a loan. Sometimes people use grants. They'll get a loan, and of course, they'll self fund as well because you got to do what you got to do while you're building and growing. Once you decide where you're going, then you'll know kind of what you have to do to prepare for that. So, how are we going to prepare for where we apply? Documents to pull. So, if you're going to go the lending, investment, grant, typically they will ask you for these documents. You will pull tax returns, whether that's personal or business. Most of the time, it's both. And you will normally need about 2 years. Lenders like to see 2 years of tax return history. Like I said, personally, business, whatever. That's typically the standard. You will need bank statements. And again, that's personal and business. And they typically ask 60 to 90 days of bank statements. And they like to see that your business is separate than your personal items. It's cleaner that way. They can see it. I know in the small business world, sometimes that's not possible, especially when you're self funding. So, anytime you make a transfer from a personal account to a business account, most banking platforms have a place where you can put a note in it, owner deposit, something. Right. Label it, your accountant will thank you, your banker will thank you, everything. And then whenever you're like, okay, the business is finally making money, I might be able to get some of my profit back to myself personally. You have that documentation saying, okay, this is how much I deposited in there. This is from me, this is from me, and go from there. And then you'll be able to get, yep. And then you'll be able to get the owner's draw back. And it's all documented, beautiful. I'm telling you, your accountant will thank you. The next document is going to be proof of income. So typically when you're starting a business, you don't normally take a pay check from that business until the business is established. You can, if you're hitting the ground running and you're able to make money and you're able to give yourself a paycheck, that's phenomenal. Not a lot of businesses get to do that for the first year or two. But keep your proof of income. So your proof of income includes W-2s, pay stubs, include all of your income that you make on this business or other businesses. And then all of this will allow your global debt service coverage. So the global debt service coverage is a big factor in the small business lending. It basically relies on the business cash flow, and lenders analyze it to see the risk of the loan. It is
again, global
debt service coverage. So GDSC. And that is out of everything you have, personally and business, like what is the ratio of repayment? If you're able to cover everything globally that you have to repay the loan that you are requesting. That's the number one thing that the lenders look at. The next thing is your debt schedule. Your debt schedule does not have to be fancy. You're going to list all of your debts that you have. You're going to write down if it's a current loan, if you already have it. If it's a current loan, you want to know where you got it, who's the lender, the rate, the balance, the origination amount. Put it all out there. when it is due, how much your monthly payment is. And it doesn't have to be fancy. But definitely include your debt schedule because the lender's gonna wanna know what you currently have going on with the business. What other bills do you have coming in? So that way they can, again, see the repayment option and see what's coming in and out of the door. The organizational docs. So this includes the state corporation commission documents that you probably already have when you establish your business. So the articles, the doing business as, if you have a DBA. This includes an LLC, operating agreement, whatever you need for your business type. They're gonna wanna know that. Now, lenders do have access to the State Corporation Commission's website, so most of the time we can pull them. So you wanna make sure that you are active and current with that. Some people have to renew it every certain time frame. Some people don't know that. They're like, oh yeah, I did that 15 years ago, and then that was it. So just make sure you can look it up. You can get right on the SCC website. You can check your activity. You can pull your annual report that you filed to make sure it is accurate. Make sure the owners are still current and everything like that in there. Then you're going to need, of course, photo IDs. So any sort of driver's license, passport, anything like that to say you are who you are. And you'll need it for all of the owners for the business. So just prepare for that and make sure that they are not expired. Because you'll find out really quick when you get there and they ask for it and they're like, did you know that this is expired? No. So that's what we have for the documents to pull beforehand. If you go in there and you have all of this, your lender is going to fall out in the floor and be like, you are phenomenal. Documents to prepare. So this is documents that they are going to ask you to pull on your business, if not your projections, if you do not have them currently. So cash flow projections / history. So based on the real numbers, so let's say we have 10 widgets, they all sell for $5. How many times have you sold them? You know what I mean? So base it on your real numbers. Also, you can use your assumptions. Basically, the lenders will need a coherent plan of growth. So we can see, okay, this candle sells for $5. You have to sell this many if you plan on making this. Simple enough. And then prepare for your figures in your cash flow to be discounted at least 25 to 40%. That's normally the standard. So what that means is you say that I'm going to make $5,000 by selling these products. Reality, in a perfect world, you're able to sell 10 of those products, you make your $5,000. Great, this is lovely. In the real world, you may not reach that goal every single month of every single year, like throughout the years. So they will discount it. So they will say, okay, we'll give her 75% of what she thinks she's gonna make. So they'll discount it by 25% to get real life or to account in case growth is slow, in case we go through another pandemic or something like that. They will account for that. So prepare for them to be discounted 25 to 40%. The standard debt service coverage is 1.25 to 1. So they want to see that you can cover 1.25 of every dollar that you borrow. Does that make sense?
What was that called again? Standard.
Standard debt service coverage. And that's how lenders will determine that ratio based upon the documents that they're pulling, that you're bringing to the table. Many banks will not underwrite based on projections. So again, that's kind of where the flexibility comes in, where CDIFs fit into the space of lending, because we are able to use those projections to help build that foundation and then build that history, get it going. And then once you have that 2-year history that bank is looking for, our job is to prepare you. You can go back there. You can say, okay, I have the history you want, finance it traditionally, and you should be good to go. What they want to see in the cash flow or projections, they want to see reality, not perfection. So if you say, yes, I have to 75 business calls a day, reality is not going to be that. You'd be on the phone 2 minutes a day, like 2 minutes for every call. Like, reality doesn't make sense. So just kind of be cautious about that. The next document is going to be that balance sheet. The balance sheet is valuable for lenders for the purpose of evaluating collateral. So the balance sheet shows your assets, and that will kind of value what kind of collateral the banks or lenders have for that. The next document is your profit and loss statement. It is also called a P&L. Most lenders will just call it a P&L. Profit and loss. It's also referred to as an income statement. So you can see what's coming in, you can see what's going out. Most of the time your accounting software has the capability of you going in there and say, print off this report for me. If not, I'll get to it later, but I have a really cool tool that can help you run some stuff as well, to get those figures. If your accounting software doesn't do it, or you are your accountant.
Right now,
Like I said, use whoever you can, and that will take care of that. The next document is, in my opinion, the most important document you can have. And that is your business plan. Your business plan is a living document. That's what I call it. So it is a living document. You build the bones of it once, but you should constantly be revising it and updating it. And it's kind of just like your resume. It shows where your business is growing. Stick with it. Most people will create it because they need to in the beginning, and then they never touch it again. So please use your resources for this. Rosie with SBDC, I joke about this, but I'm 100% serious. I can pick her business plans out of a lineup. Her business plans are phenomenal. Clients feel so great after having her help with these business plans. I can do them. I have no problem doing them. But Rosie does such a phenomenal job. Like I said, I could pick hers out of the lineup. So invest in the time. She's a great resource. She will help you, walk you through it.
I'm sorry, who's Rosie?
Rosie is the SBDC lender or SBDC consultant for Culpeper.
What's SBDC stand for?
Small Business Development Center. And every area has one designated for them. The one for Culpeper is housed right here in the Economic Development Center. I can get you her contact information, and you can set up a time with her. And like I said, I think everybody should do it. And she can help you build the bones for it. But like I said, it is a living document, so please make sure you're playing with it. And she can also help with the projections and like making the layout, and she just She's phenomenal.
And everything is free with her.
Completely free. She offers the whole business consulting completely for free. So even better. So definitely make sure that you are using your SBDCs for those things, because your business plan is going to be the number one thing that the lenders, when they present your loan to the higher ups, the loan committees, whatever they need, those individuals are going to read your business plan and they are going to ask questions about your business plan. So this allows you to portray yourself, your goals, your dreams, all on paper to everyone. So it's very important. You don't want to you don't want to miss putting in the effort. Like, this is you on paper.
Mhm.
So you want to definitely make sure that you have the time, you're investing in that. And like I said, the SBDC does the one-on-one business counseling. They do, they know everybody, so they have the right CPAs. If they have a whole Rolodex of resources, I think everyone should visit a SBDC in their business lifetime. And they will look at the figures, they will give you advice on them. I couldn't even tell you enough good things about the SBDC. So definitely make sure you're using somebody for your business plan. Just sit down. It's a free consultant. Do it. All right. So your credit story. Your credit story is probably one of the most important aspects that people look at. So what does your credit say about you? It shows your history. It shows your score. And it shows different reports and everything like that. It's called your story because it's not just one element. It's not just what is your credit score, here's that. It shows, it shows a lot. It shows your payment history. It shows the principal balance. It shows anything that you missed, anything you were past due on. So if you have one account and you're like, hey, you missed 3 months of this, what happened? Oh, I was laid off those 3 months. That makes sense. So it tells a story. If you were just like, oh, I just didn't want to pay them the 3 months, that also tells a story. So good or bad, it will tell your story. So it is very important. It will affect where you go for lending and what products and options are available to you. So you want to make sure that you are reviewing your credit report every year, at minimum every year. You can go to the annualcreditreport.com and you can pull them for free on all 3 bureaus. I have one client, she pulls them every 6 months, but she has it staggered. So she'll pull Experian 6 months. Then she'll pull TransUnion 6 months later, and she'll kind of stagger them throughout the year. You want to make sure that you are checking them. That way you're not caught off guard by anything. You want to check them for errors. Most credit reports have errors on them. Whether it is an address that you've never lived at. They could have picked the address up from anywhere at this point. Especially if your name changes, you want to make sure that they are reporting under your proper name. Sometimes when you change your name, it stays in a maiden name, or if you have a hyphenated name, sometimes it'll report under one name and not both, or it can get messy very quickly. And then you want to make sure that nobody is saying that you were late on a payment when you weren't. So you definitely want to check it, look at it. You also want to make sure you don't have fraud. So, especially in today's world where everything is virtual and the technology and everything like that, you definitely want to get on. I was going to say, I leave my credit reports frozen. I lock them. You can put a security freeze on them. If someone needs to pull my credits, I need to apply for something, I ask them, okay, what is the time frame that you're gonna need to pull it? Because I will unlock it and I will only leave it unlocked for a maximum of 3 days. So you got 3 day window to do what you need to do, and then it's gonna be frozen again. That's the best way to do it. But some people don't. I definitely recommend freezing it. Just less likelihood of something being fraudulent. So anything we can do to mitigate that risk, we should do it. Let's see. So when it comes to your credit score, no funder is like universal. They all have different criterias. They all have sometimes minimum credit scores. They sometimes have where you can only show like 3 late pays to fit into their box. Every box is different. Every lender has that flexibility of making it different. So sometimes it is good to go in and shop. Just like you would for a car, go into these banks, ask them what their lending criteria is. Some of them can tell you, some of them don't tell you. It doesn't hurt to ask the question. Are you able to share with me what your lending criteria is? If you're saying that you have a minimum credit score of 700 and I'm at 699, I'm not going to apply for you because then it's going to be a hit on my credit score. You know what I mean? So just ask them. It doesn't hurt to ask. Like I said, sometimes they'll tell you straight up front. Sometimes they're like, well, we look at many factors and all the things. And that is true. But is there anything concrete that's like a deal breaker? And they will normally tell you. So with that, what are some automatic disqualifiers? We call them speed bumps. So typically a speed bump is going to be a uncharged bankruptcy. That
What
is,
does that even mean?
so when you file a bankruptcy, there's ones that are discharged and one that is undischarged. So a discharged bankruptcy means that it went through the whole process, the court determined, they granted it, it's there. If you're in the middle of a bankruptcy, it will remain undischarged. And typically what that means is most lenders won't touch it because then you could file it in with your bankruptcy. So you could turn around, get the loan, and then turn around and claim it on your bankruptcy. Makes sense. This is the defaulted federal student loans. This is a speed bump. It's an automatic disqualifier for CDIS, at least for my organization. What this is because some of our lending dollars come from federal grants, we can't rob Peter to pay Paul, if that makes sense. So with the new laws changing and student debt repayment becoming a more prominent thing and all of this, it's kind of, we're seeing them more often where you need to work out a payment plan with them. It can't be defaulted. The other thing is delinquent tax liabilities. So you're behind on your federal taxes and you do not have a payment plan set up. Most institutions will say, okay, you need to handle that before we can talk about anything. With my organization, if they're defaulted, we see that. Do you have a payment plan set up with them? If so, can I see a copy of it? We do our due diligence to say they are working on it. They have not been late. We see that they're doing what they're supposed to be doing. Okay, great. Another thing is restricted industries. So depending on certain industries, the laws aren't clear about things. So many businesses that fall into adult entertainment, vape, CBD shops, or money service businesses, MSBs, that's what they're called. Some of the traditional lenders are like, nope, absolutely not. Like we can't serve those industries. Typically it's their morals and things like that. Sometimes it's federally regulated that we're not able to serve these things. Every lender can be different. So you can ask them for if they have any restricted energies, if you think yours is kind of on the line. For people in financial services, I also cannot do multi-level marketing businesses, so anything that's pyramid related. Typically because it's one big organization and you're an independent consultant of that, and it just gets messy and all the things. So that is a industry that we're not able to serve at this time. You definitely want to iron out these speed bumps before you apply for the loan. And then you need to ask them, is this a no or a not yet? So the CBD vape industry, typically right now, it's a not yet. They're waiting more clarifying laws to come out, seeing what they can, federal versus state level laws and all of that. So typically, it depends. It may be a flat out, no, we will never be able to serve this kind of industry. And you just have to ask them if you think you're kind of fall in that gray area. Any questions so far? Okay. So the 5 C's of credit, and this is going to be what I call the business edition. The 5 C's of credit, this will be to analyze a business loan through the lens of businesses. Some people will tweak these. I've heard as many as the 7 C's of business credit. These are going to be the most common 5. So the first one is going to be your character. So what this means is your credit history. Will you need a explanation for the narrative or any irregularities that you see? Will you be able to personally guarantee the loan? So this is where that global debt service coverage ratio kind of plays into it. Is, okay, until the business makes money, can you personally guarantee the loan under your current income? And that's that whole global debt service that they look into. Do you have established business credit?
Would that include like just what you have in savings or?
It would include everything.
Just whatever.
Yep,
not
whatever. Yep.
Can you cover it?
Yep, exactly. Exactly. And they will take everything into account that you have. That's why most businesses will have someone personally guarantee a loan. Or will be asked to personally guarantee a loan, depending on what institution you're getting your lending with. For startups, this is a huge factor. It is often the difference between it working and it not working. Because if you are a startup business and you don't have any income coming in, most of the time they say, okay, well, if for some reason they're doing renovations, they won't have any income coming in for the next 6 months, can they personally guarantee that they will be able to make the first 6 months of loan payments? So that's why they kind of calculate that. Also, character falls under the personal interaction. How timely are you? How willing are you to learn and develop your skills? We all have things to learn. Are you open to that? Do you have a good team or a professional that you're working with? So marketing, lawyer, banker, CPA, or are you doing it all by yourself? 50-50 shot these days. So it basically says, okay, who are you? And it kind of judges your character. Along with, of course, the most important thing, your credit score itself. So the second C is going to be the collateral. Secured loans have lower rates. That makes sense. They have the collateral to say, if something goes south, do we have means of making the money back? So the collateral coverage ratio. So what that means is it's the collateral value that is discounted divided by that loan amount. Do you have emotional equity? Do you have skin in the game? That makes sense. What do you have? Are you willing to put it up as collateral? Higher collateral coverage ratios can make it easier for a borrower to qualify for a loan and potentially secure more favorable terms. So sometimes if you have what I call more skin in the game, if you're able to do the collateral, most of the time, the interest rate is lower. Bonus, we love that. But also sometimes it will also make your monthly payment lower or your term longer, depending on what you have as collateral. Typically, loans that are secured by real estate, most lenders can go out longer terms. Makes sense. If you have a 2012 car that you're using as collateral, that'll be discounted because you can't get a loan and use your car as collateral for 20 years when it's already so old.
Right.
So it really depends on your collateral. The UCC liens, that is basically what they do is the lender will put a UCC lien, which is like a business lien on business assets. That is so it is recorded, it is out there. If something goes south, they legally have a right in a contract that you are agreeing to, saying that they can come in and collect that collateral. It protects you, it protects them. A UCC lien is normally put on the business assets that have weaker collateral. They are more value to you than they are to the lender. So if you have your furniture and fixtures, and that's what you're going to use as your collateral, the lender really doesn't want to have 25 tables and chairs. They're more valuable to you in your business than they are to the lender. But when in doubt, the lender, basically that UCC lien is like a contract saying the lender does have the right to come in and collect all of that from you if at any point it is needed to. So like I said, it kind of protects everybody. The lien position will also kind of determine the collateral. So usually you can't get a second or third lien position on a car. Typically that's only real estate. So if someone wants to come in and use their house as collateral, but they have a first mortgage and let's say a HELOC. So that would be, the HELOC would be their second. Some lenders will say, okay, that's okay. We'll go ahead and put a third lien on the house because that's the only collateral that they have. You know what I mean? Some lenders do that. Some people, usually some lenders will say, no, I'm sorry, we won't take a second or a third. It has to be the first lien position in order for us to do this loan for you. Makes sense because they're riskier. Everybody has to get paid out before that. So it depends. Like I said, some lenders will do that on real estate. They definitely won't do it on a car. They won't say, okay, we'll take second on this car. It's very rare that it will happen. How do you value your collateral? Kelly Blue Book was a thing. Most lenders use the NADA, so that's like the national standards for houses and appraisal. That's normally the most common. Some institutions will use a tax assessment. We will use, People Inc. will use a tax assessment if we need to. If we think it's going to come in close and it's cutting into the edge, we'll say, you know what, I think you would be better off getting a full-blown appraisal. It does take more time. But institutions are not going to be like, oh, I pulled this off the Zillow. This is how much my house is worth. It's not going to happen. And it's probably not going to be the same value that you pay for it, depending on what it is. You also most lenders will do a title search to make sure that there's nothing special that's going to pop up, especially when it comes to land and everything like that. it all has to be a clean title search. So clean lien, clean title, everything like that. The capacity. So with the capacity, this means your cash flow. Can you repay this loan and still grow your business? You want to stay as cash flexible as possible, but you also want to think about the cost of the loan. AKA a low monthly payment is not the end all be all. Don't get sucked into an overpriced loan with a more attractive monthly payment. So you want to look at the rate. That makes sense. You want to say, okay, yeah, but this one's only interest only payments for a certain amount of time, but then that principal kicks in. So you want to kind of weigh out your options. And if you don't understand any of that, that's fine. Call me, call your technical assistant, call your Rosies, your SBDC people, run it through them. Call a CPA that you trust. Call a friend and be like, does this make sense to you? Shop around. Don't think that just because you go in there and they promise you the moon, that they're your best option. Definitely shop around. Think about the total cost of the loan. So, yes, they may flex it out 15 years or something madness. And yes, you have that low monthly payment, but do you really want to be paying on that for 15 years? Like, does it make sense for you to be paying on that for 15 years? Probably not, unless it's real estate. But some of these hereditary loans, yes, they want, I can have your cash in your account tomorrow. Okay, but your interest rate is 25%. That's horrendous. We don't want to do that. They will examine your financial statements when they do your cash flow as well. So again, just make sure you have all that in your business plan and it all makes sense for you and your business. Loans that do not calculate capacity to repay are typically the sketchy ones. So any kind of loan that's like, oh, well, we don't need your income. They don't verify your income. I would definitely be aware of that. Be like, okay, they're not asking me to verify anything. They just want me to give them a number and they're not double checking it. That's normally a predatory red flag. That's a loan I probably don't want to be involved in. Okay. Capital. Okay. So capital. So what do you have to invest? So capital is anything that confers value or benefit to the owner. That makes sense. So what do you have to invest? 10, 20%? Most business lenders want to see that you have a equity investment from the owner. Basically saying you have skin in the game. You have used 10 to 20% of your own funds into your business to make your dreams come true. You have skin in the game, you're invested in your future, you want it to work out. The lender does not want to feel that they are incurring all of the risk and investing in the business more than you. That makes sense. If your heart's not in it, why should theirs be? This is where kind of CDIFs can step in and provide value. We are more flexible with the clients. We are also a valuable partner for the financial institutions. And we do a lot of participation loans, kind of like what I was saying earlier, where if a bank can only do 80% of a loan and you just don't have that extra 20, we could partner where we will provide you that extra 20 because we see we can do that character lending we can see your heart's in it. You may not have anything of value, but your heart's in it. And we can see that. We can take that risk to be able to get you in what will serve your business. So that's kind of where we partner with a lot of financial institutions to bring that to the table. If you do have sufficient collateral or sufficient capital, they want to know, why aren't you using it for your business? So if they see you have 2.2 million sitting in your savings account, why are you there to get a loan if you don't want to put anything up for it? That's another red flag in the lending world. But why is kind of what I say. But why? Sometimes they say, oh, my CPA told me to. But why? You know what I mean? Sometimes it makes sense, sometimes it doesn't make sense. Sometimes the answer is as simple as, I need to establish business credit. That makes sense. Yes, you're right, you do. At this point, some multi-million-dollar companies don't have any credit. They've always used what they have. And so you can see that history and things like that. That to me is a makes sense moment.
Mhm.
Simple enough. Okay. So the conditions. You want to make sure, it is a lot of words. It is normally a whole contract. Don't feel pressured to sign something. If they say, okay, we're here to do your loan closing, you can always ask them why they're scheduling it. Great. I know you have the loan closing documents. Can you send them to me a day in advance so I have time to read over them before I sign them in your office? I think you should always ask them for that. You should look over them before you sign them. Because sometimes when you get in there, they're staring at you. There's 17 different paragraphs and they're like, oh, initial here. And then they're just staring at you and you hear them breathing in the awkward conversations. It can be awkward and it stresses you out and you're like, oh my gosh, I can hear them breathing. They're waiting on me. I'm not reading fast enough. Wait, now I gotta go back and reread this. Don't feel pressured. Just ask them, hey, I wanna make sure that I'm ready for the loan closing. Can you go ahead and give me those documents so I can have questions prepared for you? Lenders love that. They love that. Do it. Take advantage of it. You also want to make sure that if there is a condition of the loan, how are you going to meet that condition? So sometimes they will say, this, let's say 20% of this loan has to go to you hiring a new employee. Okay, what does that look like? So they'll say, okay, when you hire this new employee, I need some kind of proof that you hired a new employee, something like that. Sometimes it is, okay, you need to pay off this debt with this portion of this loan and send me the receipt. So just make sure you know what the conditions are before you sign it. Sometimes it's the purpose of funds. Again, okay, you're using this to pay off the debt consolidation. We need a receipt to say that you paid it off. So make sure you're using it the way that it is intended and agreed upon. Sometimes working capital, that's pretty flexible. You use it for whatever you need it for. And when you get working capital loans, the lender typically is the line, I need receipts for every single thing you buy. That's typically not the case, but just make sure, just ask those questions. Conditions of the market. So again, what is the rate? What is the appetite for risk? What is the appetite for your industry? How badly do they want to make this loan? So those are some questions that you should be asking yourself and the lender. Like, if they're just like, okay, yeah, no, we need to give you this money. We need to give you this money. Why? Why? Are you trying to trap me in this? Is this not good for me? Is this not healthy for the market? Like, what's going on? There is no such thing as free money. So sorry, but that is not a thing. It all costs something. No one is going to give you capital to build your wealth without expecting something in return. Whether that is interest rate, stake or equity in the company, the outcome metrics, so grant or matching funds. They're going to want something, and that's normal. I think that is normal. All right, before actually, I'm gonna go and finish this. Remember to give yourself time. Fast money is more expensive. That makes sense because the interest rate's gonna be higher. It's probably gonna be predatory practices. So give yourself time. Always have a plan for repayment. So match the purpose to the term. Don't go out and say I need working capital for 15 years. Doesn't make sense. Borrow for investment and not revenue. So invest in your company, invest in your goals. Don't do it to say, okay, I'll turn around and make this right back. Invest in what you physically need for your business to be successful. Mistakes. So common mistakes include slow document prep. So the process moves quickly. So if you're taking a long time where the lenders have like, okay, I need a business plan, and you don't have said business plan, your business plan takes time. So allow yourself time to do that. If you go in there and they say, yes, a business plan is a requirement. Okay, great, we can do that. Can you give me your business plan tomorrow? Nope, sorry, I can't make that timeline. I need to come back when I'm more prepared. And that's 100% okay. Once you have all of these documents, the process, like I said, moves quickly. So having the time to prepare the documents in advance is going to be your best bet. Like I said, if you show up to I call it a loan interview. See if they're a good fit for you. See if you're a good fit for them. You're interviewing them potentially. You're shopping around. You're asking them all the questions. But if it's like, okay, great, I think that you are a good fit. Let's move forward. And you have all of your documents there. Like I said, the lender's going to fall out on the floor and be like, yes, let's go. Let's do it. It's going to be more efficient for you, more efficient for them. And it also shows your character. I am prepared. I have thought this through. I have all of the things. Let's go. So their confidence in you is already higher. So slow document prep is kind of a speed bump that we see frequently. Also, trying to borrow too much. Think about how much you realistically need. At the end of the day, everybody needs millions of dollars. You know what I mean? And so trying to borrow too much, loans can grow with you. So if you say, okay, I need $2,000 now. Okay, great. A year into it, you're like, man, I could really use more. Call your lender and say, hey, is there any way I could do an increase? You see the positive history, you see the adequate collateral. Could I get an additional $5,000 now? They are more willing to work with you when you're already in the door. They see that you're growing and you're like, oh wow, like this investment sets up for success, but now I can't keep up with it. I need a new piece of equipment. That makes sense. Okay, great. Yeah, let's keep investing in them and just get what you need. You don't have to get the full $250,000 because that will set you up for the year. Get what you need, hit that milestone, and then you can keep going back. They're not going to say, no, I'm sorry, you're locked into this forever. We're not going to extend any more credit. It's very rare that a lender will say that. So not borrowing too much right out of the gate sets you up better for success in the long term. Hidden expenses and overdrawing your net income. Does your business not cash flow? Is your business right side up? Can you probably find capital somewhere else? So with this, if your business is not doing great, you're not going to borrow money to then put back into it. Basically, what we would do is we would say, okay, your business is not making what you think it should be making. Then we kind of coach and guide and all of the things with, okay, let's explore different avenues. What do you think about investing your funds in here? What about this business model? And we kind of help you pivot and see what works in the market industry. getting that technical assistant guidance is kind of what we're here for. You say you've been doing this for 30 years, this is working, but the world isn't there yet. Okay, so then let's tailor just a little bit out of our comfort zone, because maybe we need to market it differently. Maybe they're just not ready for me yet. And if that's the case, that's fine. That will just become a longer term goal, and we need something short to generate income now. And we can kind of help guide you through that. Round table, basically. What do you think? What do I think? Personal things, like it's just a big round table and you just kind of iron it out. And then we have the insufficient collateral. So with this, what you paid is not what is worth to the lender. That makes sense. As soon as you buy that $40,000 brand new car and you drive it off the lot, and now because you drove it 2 miles off the lot, it's now only worth $20,000. That's a thing. It makes sense. It's an unfortunate part of the system, but that's where sometimes lenders will work with you in other ways. They're more flexible on what you can use. Sometimes they'll use multiple things, and there's different workarounds for those kind of speed bumps. And then another speed bump that we see frequently is suppressing your net income. No one wants to pay more taxes when they do not have to. This is the biggest thing. But if you suppress your income in order to pay less taxes, when the underwriter analyzes your financial standing, it will show that your business doesn't make any money. Most businesses take advantage. That's the CPA's job, is to take advantage of your tax credits. I have a multi-million-dollar company, multi-million. Their tax return said that they made $150,000 last year because they took advantage of their tax deductions. So you need to be cautious with your CPA and be like, yes, we could take advantage of all of these. But then knowing that in the next year or two, I need a loan, that's not going to look great. So yes, I do want to lower my taxes, but I also don't want to lower them too much where the business now isn't making any income. So you kind of have to think about, again, your business plan. What does it look like 3 years? What does it look like 5 years? And go on and go on. Some lenders will say, okay, I'm sorry, your business is like fit into that box. Or that traditional lender will say, your business didn't make this much income. You now don't fit in this box. And then they'll refer them to a CDIF. So with the CDIF, we can say, like I said, we have a little bit more flexibility because we're not federally regulated. But then we can say, this person does make income, they're just taking advantage of their tax credits. Lenders can see that, but that doesn't make it so it fits in that box. You know what I mean? To the average lender, yes, that totally makes sense to me, but our policy or guideline is blah, blah, blah. So just be aware of what your future goals are, what your business needs are. Talk to your CPA, ask and be like, okay, because they don't know your future plans until you tell them, because they're knee deep in the now. What does it look like now? But if you talk to them, I mean, you guys should have a very open flow conversation. I think the business is going to need a loan in the next year or so. So they're going to be asking me for 2 years tax returns. What can I do to help us set us up for success to be able to get that loan? Yes, I know I'll be paying a little bit more in taxes now, but at least we'll have business income for that purpose. So just talk to them. You only have to pay income tax on the money that you've made. So it's a good problem to have, but at the same time, it's also hard. Report what you earn so you can borrow when you need it. That's the basic gist of it. All right, now, how to strengthen your loan proposal. Tips for a strong proposal. Be prepared. Know exactly what is expected of you. Some of it is in the training as far as the documents that you need, the prep. Be organized. So in your loan proposal, know how much you want. Ask what you need. Be organized about it. Keep good record. Right? Up to date. So anytime you go and do something, you don't want to say, oh, well, I haven't done my books in 3 months because of the last quarter. So give me a few days and I'll get that back to you. Be prepared, be organized. Also, give timely responses, stay on top of it, but don't be in a rush. Again, don't let the lenders peer pressure you and saying, I need this document by tomorrow, if they only give you like 24 hours. I'm sorry, I'm not gonna meet your deadline. We just need to stop this process and I'll pick it back up when I'm ready. Don't be afraid to say that. Don't let them peer pressure you into things. It moves it along in the process. Like sometimes it does take a few days to gather something. Not a problem. But then wait 6 weeks and then say, okay, here's that document you've been waiting for. Now your whole financial picture could have changed in those 6 weeks. So just stay timely. Get in the game. Show that you are ready to invest, whether that's what we call sweat capital, emotional equity, whatever. Put your heart out there. This is your business. It's your dreams. If not, everyone would have the exact same business and all the things. So don't be afraid to say, I don't have the collateral, but my heart's in it. And see if they can work with you with that. Some people can, some people can't. I get it. But what can we do to get creative so that way I can make my dreams come true? So having those honest conversations is the best part. Build good relationships and work together. So again, that honest communication. The small business owners get spoiled and sometimes they take on everything themselves, and sometimes that's a good thing and sometimes that's not. But a small business community, they get the support. Use all of your resources. The best thing about our small business community is if one person can't do it, that person knows 5 other people that can tag in and help. SBDC, community economic development, like that is what makes us a whole business community. Now, county, state, federal, all of them do too. But your community is going to be your customers. They're going to be your CPAs. They're going to be your bookkeepers. They're going to be your tax advisors. Like it takes an army, so use your army. What to do when they say no? They are going to say no. Somebody in this world is going to say no, and that is okay. When they say no, why did they say no? So ask. Sometimes they'll tell you, oh, the collateral just wasn't there. Okay, was there anything else that you were kind of on the fence about so I can better prepare for the next time or the next lender I go to? Is there anything that you can tell me up front that made that decision? Take that criticism. Don't argue with them, because at that point the decision is already made. If they're coming back to you and saying, no, not right now, they've already made that decision. That's fine. Get the most information you can out of them. So why did they decline it? Was it your debt? Was it your credit, your cash flow, the industry, market conditions right now? Market conditions. The world is crazy right now. So everyone's kind of being more lean. Everyone's kind of being more conservative when it comes to things because of the unknown. So make sure that you address any underlying cash flow or operational issues that they see on their end that you may not see on yours. Even if you don't agree with them, like I said, just take that feedback. Don't ignore their criticism because other lenders might see it that way, even though you're like, that doesn't make sense. They just don't understand me. That's fine. How do you prepare the other person to see what you see? Not a problem. No two financial institutions are the same. So like I said, some of them have different risk appetites. Some of them have different industry targets or priorities that they need to invest in. Does another option make sense? Go shopping, shop around. Now, don't apply everywhere. That's where people are like, oh, okay, well, I apply here and here and here and here. We don't want to do that. We just want to shop around. We want to see if we think that we might fit into their box, if they're able to help us fit into their box. But also, don't apply all at once. So if one person says no, give yourself some room to apply somewhere else 3 months down the road, next month, something. Don't go and say, okay, this person turned me down Monday, this person turned me down Tuesday. By Wednesday, you're like, oh my gosh, another one. Give yourself time in between there, because lenders do look at your recent pulls on your credit. Anybody who applies in multiple places in a short time frame may be considered high risk, because it looks kind of like they're desperately looking like survival mode. They need this, which is fine if you need this, you know what I mean? Like, make sure you have those conversations with your lender. Typically, a good lender will say, okay, when's the last time you applied for credit? If you say yesterday, be like, okay, where? Front load them, so they're not surprised. See if they do hard pulls versus soft pulls on your credit. Soft pulls, of course, don't affect your credit score, where hard pulls is a hard pull and it can pull down your credit a point or two. Point or two is nothing unless you have 30 credit pulls, you know what I mean? So they can add up, but don't rush and apply for a bunch of different credit all at the same time. It will undercut you in the long run and make it look like you're kind of credit hungry. So just be aware of that. Don't take it personally. That's the hardest part, because this is your baby. This is your business. This is your life. You're like, this is my dream. Don't take it personally when they have to say not right now. Just because that one person isn't ready for you doesn't mean that every lender in the whole wide world is not ready for you. So just reset your timeline, start over. How you can spot a bad credit product. So this is bad credit product may mean crazy, extreme, high predatory loan. Your interest rate is 50-something%. They want a prepayment penalty of $20,000 if you pay it off early. Craziness. But it can also mean that it's a bad credit product that doesn't fit your needs. So if a credit product says you need to make a weekly payment versus a monthly payment, that may not fit your needs. Now, if you're retail and you're getting credit card sales every day, that may work for you. Most of the time, one monthly payment is the norm, but just make sure you're looking at those. How to spot the predatory lending. There is not technically a definition of predatory lending. It is a set of practices or features built into their loan services. A good deal is when you feel like you got a good deal. I definitely think that excessive high interest rates and fees, like, you've got to read it. And do not sign something if the interest rate and the fees are missing or blank. I'm finding some of these contracts I'm reviewing for clients that were coded loans. They got online, they needed to survive. I get that. They signed something, and when they sent me a copy of it to review, those things were missing. So then when they sent it back to them, then they inputted what it was. So then that's not good lending. That's not great. So just make sure that there is no blanks in whatever you're agreeing to and you're signing. Very short repayment terms, so I consider these like payday loans. They are normally crazy amounts. They're like, oh, but you only need it for 4 days. And they'll charge you like 30-40% of whatever you're borrowing. Anything that, again, they're pressuring you to sign quickly, typically you get that gut feeling, they're rushing me, this is probably not a good idea, follow your gut. The prepayment penalties, be aware of them. Make sure anytime you get a loan, that's the number one question you're asking. Is there a prepayment penalty? If for some reason I hit the lottery tomorrow and turn around and pay it off, are you gonna charge me a fee for doing that? If you are, my gut, no thank you. Most good, safe lenders do not charge a prepayment penalty because that's our job. They want you to be able to be successful. We're not gonna penalize you for being successful and being able to pay it off. Like, that's what we want. If the company has no physical address, that's a hard no for me. If I can't verify their history, go on their website, do their research. If you can't figure out their history or all of their reviews are just done this year, that's gonna be a hard no for me. Make sure you're looking at them, especially the ones that are online and you can't walk in there and see somebody. I'm a little bit more cautious. I Facebook stalk them. I look up, I Google everything. I'm checking with the Better Business Bureau. I am that kind of person. Trust no one and do your research. If they have poor transparency, so you're asking what your interest rate is, and they're kind of giving you like the go around, well, it depends. Okay, well, this and that. Definitely make sure that it is in writing somewhere what it is, because if they're not being transparent about their policies or procedures, that's a problem. If they're saying, they tell you at the end of the loan, oh yeah, but we're just gonna auto debit this, and you're like, no, I don't want to give you my bank information. That's kind of poor transparency where they didn't tell you up front, we only take this form of payment, you know? If loans are too good to be true, they normally are. Simple enough. Make sure that you read the Truth in Lending Act disclosure. That has all of your pertinent information to your interest rates, your minimum payments, your term, everything like that in one page. It will also show the loan amount, and then it will show the term, and then it will show if you pay, how much that loan will cost you if you let it go the life of the loan. So it will have the principal amount, let's say $5,000. Then it will have all of the interest for the term of the loan added onto it, and you'll see that separately of how much you are paying for that. So please make sure that you're reading that and it's accurate. And then the last thing is that the credit, have it before you need it. So this is where you're planning, because if you need it and you can't get it, what does that mean for you and your business? You're not kind of being proactive. So definitely think about what fits your needs, because if you get into that predicament where you're like, okay, I need it now, fast cash, I need it, I'll just take that penalty, which is what a lot of us had to do during the COVID loans. That makes sense. But if some of them had that 5-year plan in place, maybe they could have went to their bank and been like, hey, I need to extend that line of credit that I currently have. I need to increase it because this is happening. So having that in place is a good contingency rather than not having anything to back it up. A good lender, again, wants you to pay off that loan and come back for another one. They shouldn't just be like, here it is, pay it off, don't come to me again. If that happens, they're probably a hereditary lender and you're probably gonna have a terrible experience and you're not gonna want to go back to them. So just be on the lookout for that. In conclusion, the whole moral of the story is every business must cash flow and there will be a time to invest in